Hello everyone, this is Andrew here with Spark Finance, and today I wanted to go over some of the beginner terms for investing in the stock market. So these are items that, if you're watching the business news, the media, or just hearing friends speaking about it, if you're not familiar with the industry, you might not know these terms. So I'm hoping to give kind of a different perspective on what they mean to see if we can explain them in an easier manner. To start off with, we have stock, shares, and shareholders. So to start off with, the stock is basically ownership stake in a company. So a company gets really big and they need more money to expand, and what they do is they offer ownership to you and I, to everybody out there. And this is a great opportunity because, people like you and me, we can now go and buy a large corporation, partial ownership of course, of a large corporation such as, Walt Disney or Bank of America, or any of these huge companies that are out there that are publicly traded and available and have stock. So this term actually came from, back in the day when they had joint stock companies. And when you think of a big company, right, in the old days you had a company like John Smith's blacksmith shop, right? And that was basically one guy owning the business. He was one owner. Then you had these companies that needed to expand and go into multiple areas, and they needed more investors to come in for ownership that could own the company, and they needed joint stock companies. They invented this. And it's evolved over time to where now we have these multinational corporations that have millions of people that own stock in those companies. And the way they own stock in that, the unit of measure is called a share. So you can own one share of stock. And a good way of explaining this, I guess, would be, let's say this jigsaw puzzle here was Amazon stock, right? Amazon's a huge company, kind of like this giant mountain on here, right? So you would go and you could buy one share of stock of this company or 100 shares of stock of Amazon stock, right? So the jigsaw as a whole is the company. But the key here is that all of the little jigsaw pieces that you can see here, these are the shares of the company. And what happens is, if you want to own part of that company like Amazon or Apple or Shopify or Netflix or Coinbase or all these crazy different companies out there, you go and you buy one share or you buy a whole bunch of shares of the company, and that just amounts to how much ownership of that company you have. So somebody over there buys it, somebody over there buys it, and what happens is all those people become shareholders. They have a vested interest in the company performing well. And that also gives them the opportunity to kind of bask in the profits and the earnings that the company has, because that's why you own a business, is because you want the money that that company is going to make. And this gives an opportunity for the everyday person to go and buy these big corporations that they could not purchase by themselves on their own. Now remember, if you take all of these little shares and you put them back together, they will total, just like a jigsaw coming together, they will total the entire stock of the company, such as Amazon in our example here. So looking at that, right, there are different things. Like when you're getting shares of stock, what are you exactly doing? There's a stock ticker symbol that people can see on TV. This is another term, stock ticker symbol. So this is a short code for a stock that, instead of having a long name that you have to write all of that out, it's 1 to 4 letters that are used to basically show ownership or show that that is the company they're speaking about. So for Johnson & Johnson, which is a long name, you instead have the stock ticker symbol J&J. And that makes it easier on a quick glance or in a quick reference to be able to see the stock price of a company. Now, if you look on the TV, sometimes you'll see the stock ticker symbol. They have it on websites as well, where it'll have those little short code entries like J&J, and then have the stock price of how much the stock is currently trading for. And when you're buying stock, you're buying one share of the stock or more shares. At each one share is that price of the stock on the stock ticker symbol right there that you see on the tape. And that ticker tape actually came from an old term where they used to have a machine that would literally print out a small, thin piece of tape, and it would print on there the different symbols for the stock as well as the stock price. And that's how they could do it quickly, and traders could actually do their trades.
In other words, the stock ticker. When the brokers met on the street, it was impossible to inform the public immediately of the prices at any given moment.
With a ticker,
Each sale is printed everywhere within seconds after the transaction has been completed on this floor. In this way, a man thousands of miles away knows immediately what is happening in the market.
Now, a lot of companies actually use this for marketing purposes or to kind of show the affiliation for what their business does. So Johnson & Johnson, his stock ticker symbol is J&J. There's basically an abbreviation on the name there. Then you have other companies like Harley-Davidson. Harley-Davidson has a symbol HOG for hog because their motorcycles are known as hog. So then you also have a company like Coinbase, which is ticker symbol COIN. You have Petco, which is woof, WOOF. You have Cheesecake Factory, which is cake. You have a giant collection of fast food restaurants known as Yum Brands, which is YUM. So you can see how all of these different companies kind of use the terminology to indicate what their stock is. You have Shopify, which is SHOP. You have finally Salesforce.com. How could you make a stock ticker symbol for that? Well, they put CRM, which is actually an acronym in the industry for Customer Relationship Management. And that's exactly what the company does. So it kind of tells you what the company does, kind of like Cedar Fair has a stock ticker symbol FUN for fun because you want to go to an amusement park with them. So it's interesting how they do that. Now, looking back at all of these stock shares that are out there and the stock prices, all of that actually does mean something. And this is the next term that I wanted to go over, was what you would call market capitalization. And a lot of times on the news or in announcements or pundits talking about this, you'll hear people say market cap or something like that, right? And you're not sure what they're speaking to there. Or they'll say, oh man, Apple, I can't believe that company is worth $2 trillion. It's so much money. How is it worth that much? And the reality is that they're looking at the market capitalization. So let's say this deck of cards, all of these cards were shares of a company's stock. And what you do is you would take the price of one share of the company's stock, let's say it's $100, and you would multiply it by all of the rest of the shares outstanding. And then that amount would actually equal the price of the full company. So that's what the market capitalization shows you, and that's the formula for it. So all of these combined together would be the market capitalization of the company. And that tells you if you wanted to buy the company, how much it would cost. So if I was an individual or another company, I would have to go out there and buy all these shares that are in the marketplace. And that's why it tells you how much the company's worth. And that's like the official measure for it, right? So it's kind of interesting here when you see on TV, like I was talking about the market cap, if it has a low market cap, it might be a growth company that's gonna grow really fast and it's gonna do lots of things. If it's a huge company like Apple, Microsoft, Google, Facebook, it's gonna be harder for it to grow bigger because it already has a large market cap. But once again, the amount of shares that are out there, this is set up by the company and it could be any amount. It doesn't really matter. You take this and you multiply this by the stock price, that gives you the market capitalization. Next up, we have these terms that you always hear everybody talking about. You have the bull and you have the bear, which is hard to hold both of these because they're kind of heavy. But you have the bull and the bear. These are terms that can refer to how you're thinking on a stock or the direction that a stock market is heading. So to make this a little bit easier, when we're speaking about the bull, right? Use these which are lighter. If you're a bull on a stock, you think the stock price is gonna increase. You think the prices are going to increase. If you're a bull on the stock market, you think that the stock prices in the stock market are generally going to rise. They're gonna go in an upward fashion. So if you are a bear, that is actually the opposite of that. The bear means that you think that stock prices are going to fall. Or if you're a bear on a particular stock, let's say you think the airlines, back in the pandemic got beat up and you think that they were gonna go down in price, you would be a bear on the airline stocks. If you thought that, maybe Amazon is gonna do really well and take over the world during the pandemic because they ship all the packages to people at home, you are a bull on that stock. And it's kind of interesting, like out of all the animals in the animal kingdom, why did they use these two, right? Like where did that come from? One of the things that they say, and of course these are always mysteries because the stuff goes back pretty far, but the bull and the the way these animals actually attack is the reason why they call these markets, or what your take is on a stock, bull and bear. A bull goes and attacks with its horns. So it comes in and it tries to attack in an upwards motion. So that's the same as a stock going on an upward trend on a chart, right? That's why the bull indicates you're going to think prices are going to go up. The bear, on the other hand, he swipes down with his big paws. He tries to swipe at the enemy below it. So when he's swiping down, that's a downward trend. So that's an easy way to remember this, right? The bull with his horns, he goes up when he attacks. The bear with his claws, he goes down when he attacks. So that's how you know which one is good, which one's bad. The bull market's good, the bear market's bad. And basically, there's also some technical terms on this. In an overall market, if it's a bull market, that means that you had a period where there was 2 sell-offs of 20% or more, and then an increase of 20%, and you see a general rise in prices. This could be anything. It doesn't have to be the stock market. It could be, collectibles or whiskey or anything like that, right? So it could be the price of boats, right? So then you have a bear, right? A bear means that the price of the stock market, right, has sold off 20% from recent highs. Once things go down 20%, whether that's the price of maybe boats, nobody wants to buy boats anymore, they go down 20%, then it's in a bear market. It's the same thing with the stock market, and that's why those terms are used there. Another interesting thing, besides the way these animals attack, is where the term bear came from. If you're a bear on a stock, that means you don't believe in the stock, you think it's going to go down. Originally, people traded bear skins back in like the 1700s. And these two terms, they got really big in the 1700s and 1800s. And they used to sell bear skins. There was something called a bearskin jobber. And he would go and he'd say, hey buddy, I'd sell you a bear skin for $100. And he didn't even have the bear skins himself. So what he realized is that he would have to go run and find somebody he could buy the bearskins for less money than he already promised to sell it. So he goes running trying to find a bearskin for, let's say, $90 to sell it to this guy for $100. And he basically benefits when the price of the asset goes down. You see, he's hoping that the price will go down now so that he can pay this other guy. He can get the $100 from the other guy by buying it for $90. So he wants the price to go down. This goes into the next term, which is long and short. You always hear people saying that, oh, I'm long this stock or that stock, or I'm long the market. So this term is basically to indicate if you think that the market is going up, if you're a bull, you are long the market. If you're long a stock, that means you own it and you think the price is going to appreciate. If you're short, think of that as like you're getting shortchanged, right? You're going to get less money out of it. So with that kind of mentality, it's the opposite of the long. If you're short something, you want it to go down. You're betting that it's going to go down. If you're long, it's like the racetrack and you're betting on a horse and you want it to win. You're in it for the long haul. You want to make sure that thing wins and it comes out a winner. The short, he wants it to go down in price. Those are the two different terms right there. The final terms we have are dividend and yield. So the dividend, a lot of companies decided they're going to pay out some of the profits, the hard-earned profits that they made, to the owners of the company. All those people that owned shares of the company. So what they do is they say for each share that you own, we'll give you $1 for a dividend in a year. And what happens is that's basically like money just going into your pocket as being an owner of the business. Now the yield is a term that they use. It's basically the same as your yield on a savings account. Let's say you were going to get 2% yield in a savings account. That's in a year, if you have $100 in there, you get $2 back. If you're going to get 2% yield on a stock, if you have $100 in shares of the stock, you're going to get $2 back from the company. So that's what the yield means. And it's actually the stock price divided by the annual amount of the dividend. And the dividends are usually in dollar terms. They'll say $1, $3 a share they'll pay out. And that's how that works there. So hopefully all of this information kind of helped with some of the different topics and terms in the financial field, because a lot of it's very confusing and they try to make it more confusing on purpose to keep out outsiders. All right, thanks for watching, everybody. This is Andrew with Spark Finance. If you want to check out some of my other videos on business, personal finance, economics, check them out. I even have a whole video on the explanation of a stock price. What is a stock price? And I have another one on dividends. Should you reinvest dividends or should you not? And should you spend the money elsewhere? So if you want to check those out, I'll put some of the links here, or check out my channel and subscribe for more great videos. Thanks for watching. I'm out.